Hello, everyone. So, as you may have noticed, there are some headphones on the seats. We recommend you putting them on because it's kind of like a silent disco operation going on here, and you will hear the audience and the panelists a lot better with the headphones. Thanks again for coming in. Hope everybody had a great lunch. I am Mark. I'm going to be your MC of the afternoon track. I'm on the Blockworks research team. And we are going to be kicking it off with a few panelists about whether crypto is blurring the lines between public and private markets. So can we put our hands together for our panelists? Haseeb Qureshi, Matt Hougan, Santiago Santos, Neuner, and Richard Muirhead.
Amazing, welcome guys. I didn't realize we're doing it in a silent disco format, which
Whoa.
is
Oh, wow.
kind of refreshing. It's kind
Wild.
of refreshing to not hear.
To dance.
Hey, well, you can dance if you want. That'd be a very good start. So yeah. So the topic today is around the blurring of the lines between public and private markets, and that is one of the reasons why I got into blockchain in the first place, is because the access to public capital anywhere around the world, the big promise. I got into blockchain around 2014, 2015. I'm kind of interested to hear from you guys how far you think we've come since then, and are we on the right trajectory? I see, maybe you can start.
Yeah, I mean, crypto's changed so much since I first got into the space. So I came into crypto full time in 2017, and at that time, crypto was still, I mean, one, it was very subversive. We're now here at DAS. I see there's way more suits than there are kind of, crypto cypherpunky people, and that there used to be no conferences that look like that. I think it's also a testament to how much crypto has, in a way, it's gotten subsumed by what it was originally trying to disrupt, and it's now disrupting it from the inside rather than from the outside. So, if you look at the Bitcoin Genesis block, it says that basically Bitcoin is an insurrection against the banks. And now you have banks launching their own stable coins, and you have them figuring out how they can accommodate what's going on in this industry. So it's total reversal from what I imagined it was like when I first came in this industry in 2017.
But I mean, so I get the feels different here, and it does really feel different from the 2015, 2016, 2017, but I still don't feel like we're making progress towards all markets being tokenized and everyone being able to buy tokenized assets.
You don't think we're making progress?
I mean, I think we're making progress, but I think it's been 11 years. And I mean, when was the last time you bought a tokenized anything that wasn't a crypto utility token?
Well, I think that's a good question for some of these other guys, maybe Santi.
Yeah.
I think in this industry, it's important to understand, like, are we making a marginal improvement to the current paradigm? And I think it's not to say that we're going to make financial systems perfect. There are clear challenges with crypto market structure, Oracle pricing. Like, anyone that was paying attention over the last 3 days understands that. But it's important to just understand, are we making the system better, more transparent? And I think if you go back to 2008, where you launched Bitcoin, and it's in response to the global financial crisis, why did the global financial crisis happen? Because you didn't have any semblance and transparency in a system that is really fragile. You don't know if your counterparty is solvent. And if you look at how DeFi has behaved, I think you're in a paradigm where, look, DeFi is not perfect, but you do have a system that is incredibly resilient and it's transparent. It's not going to fix everything, but I think just having transparency in markets is a better state than the current paradigm. So I think we made incredible progress. And days like, the last couple of days inform us of areas that we still need to fix. So, it's not perfect. I don't think we should portray it as perfect.
What's the biggest barrier that we have between where we are today and between everything trading on tokens all the time, freely, transparently? Is it a technology issue or is it a regulatory issue? I'll come back to that.
If I look at, I think a system like Aave has behaved exceptionally well time and time again. It's very robust. You had cascading liquidations. That system didn't produce any bad debt. You have perk protocols that are connecting like off-chain and on-chain for an Oracle pricing system. Well, the Oracle is like typically where things really fall apart. So I think market structure, if you want to create 24/7, 365 markets and bring in real-world assets on-chain, I think that's where we need to just think clearly of like, how do we actually create a system that is robust enough to absorb that, right? Our circuit breakers, should we be thinking about circuit breakers in crypto? when I was at Parify, it's nice to get a call from your counterparty to refill the collateral sometimes. And so I think, are we building like this Frankenstein system where, yeah, smart contracts are great, and logic is great, and transparency is great, but we just got to make sure that if we're interacting with counterparties off-chain, we need to just understand how that dynamic is going to play between on-chain smart contracts, off-chain, real-world auditors, verification of the collateral, and all that stuff.
Okay, you had a contrarian view, if I
Well, as requested, I tried to come up with one.
it's a silent disco, so you don't hear yourself.
Yeah, kind of I kicked off part-time in the space back in 2013 and helped Pantera get their position in Bitstamp, sort of right at the kind of beginning of everything, and then their position actually in Circle. And I think we certainly, going back to this point of progress, I think we certainly, if we're going to hit 2 trillion perhaps of stable coins in issuance in the next couple of years, which is roughly where JP Morgan think it's going to be, and maybe we'll come up with another stat, we seem to be making some good progress. And I think, as Santiago says, it's for very good reason in terms of the transparency. Whether it's the great financial crisis in 2008, or I can actually, frankly, the first IPO I was involved in was now 25 years ago, and the company that I'd started. And it's not just transparency, it's an inside club. It was then, and it's just as much, an inside club now. I think we can move away from those things if we have proper tokenization of all these different assets. However, there are a number of reasons. There's we need to make sure the market infrastructure is there so you can cope with, the long tail events, for example, the crises. You need to make sure there's just the right amount of regulation. And we have to be, I think, honest with ourselves that for startups, and most of what we do at Fabric is to sort of, get involved with people right at the beginning of their journey. For startups coping with solving technology problems and risk, hiring co-founders, and sort of say issuing a token and being a publicly listed entity from the get-go is pretty darn complex. So I think, we still need to work out, before we allow that to happen for pretty much any asset literally under the sun, we need to continue to work out the startup science about how we make that work effectively before, so folks either don't get too greedy or just go off the rails.
So I want to talk about this weekend just for a second. How did we do this weekend? I mean, let's actually talk about.
We're live.
We're live.
Haseeb is written.
But I mean, I think any market, the stress test is the only test that actually counts, because under normal conditions everything works well. But we had a stress test this Friday. It shouldn't have been a stress test, because if you think about the underlying cause of what happened, it shouldn't have cascaded like that. So what happened? Where did we go wrong?
Well,
where did we fail?
A few things. So one, this is the largest liquidation in crypto history.
But
why?
What's that?
Bigger. It's like 10x bigger than.
Yeah, it's 10. Well, I think some of the numbers are probably not trustworthy, but it's definitely the biggest.
Yeah.
In large part just because the market has gotten so much bigger. So in relative terms, obviously, when FTX collapsed, when the COVID collapsed, those numbers were larger, but the market was so much smaller back then compared to what it is today. So that's one thing. Second thing was that the number of traders in this market has also accelerated by quite a lot. And the APIs that people have set up to be able to accommodate all of the traders that are interacting with them, like what you saw was that it was not actually the blockchains that went down. The blockchains were fine. Solana was fine, Ethereum was fine, Hyperliquid was fine, but the APIs that people were using to interact with these things were falling over left and right. So this kind of load test, there's no practice run you can do for it, right? It's like when Trump dropped a meme coin and all the Solana wallets went down. There's no way you can simulate that kind of load, because they had basically a couple hours of borderline downtime where people could not get money in and out of Binance. Withdrawals, deposits were having issues. APIs were failing. But actually, most of the other exchanges did okay. Auto deleveraging happened. There was very little bad debt across the industry. DeFi performed swimmingly. So some things went well, some things went poorly, which is always how it is when you see big events like this. But overall, I think what it showed us. So I want to jump on this point Santi made, which is, when Parify is trading in a normal market and you're running low on collateral, you don't get just, automatically liquidated when you hit a certain price point. Instead, you get a phone call. And the phone call is a very nice phone call. It's like, hey, Santi, how you doing? Your maybe it's not so nice, but it's like, hey, your collateral's running low. We really want to top you up. We don't want to liquidate you, right? And in DeFi, that's not how it works. In DeFi, or even on exchanges, right? Like the way that it works is that the moment you are below this level, boom, you get liquidated, no conversation, no phone calls. It's cold, mechanical, programmatic. And we often tout this as one of the virtues of DeFi. But of course, if you're Parify, you maybe don't like the fact that you don't get a phone call. And why is that phone call happening? The phone call is not happening because traditional businesses are stupid and they don't understand that it's riskier to call somebody than not to. The reason why they're doing that is because this traditional business is basically, they know that you're a good customer. Mm-hmm. And they want to keep you as a customer. And the grace window they're giving you is basically credit extension. Because they're like, look, Parify will top up. I know Parify, they're good guys. And that credit extension doesn't happen in DeFi. Right now, if you're a long-term borrower,
we don't have privacy.
Maybe you want to add something.
Yeah, I actually think, so my big picture answer to your first question of how we're doing is sort of that everything is happening exactly as it should to get to our destination. I even think we sort of owe Gary Gensler a debt for holding down the tokenization and stablecoin market while our infrastructure improved. And I think to your point, by which I mean that if we had obviously, I have a dartboard that I throw at Gary Gensler's face every day. He's not my friend. But broadly speaking, if we had this kind of sort of traditional engagement in crypto 4 years ago, when transaction fees were spiking on NFT volume, the whole system would have collapsed. Wall Street would have written it off for a decade, and we would have been delayed. I think we're going to get there faster. And I feel like that about this weekend as well. Everything you said is true. And I think we'll get better next time. And a few people sort of effectively had those phone calls, right? There's a lot of talk about Athena being hard priced. That's almost the equivalent of the Parify phone call. And I think next time there'll be more of those bilateral arrangements. So I sort of think we're training at the right pace to get to the ultimate destination. And it's almost happening almost perfectly. So I think we're making pretty good progress.
Well, you seem satisfied even after the carnage of this weekend.
Can we go back to
maybe not happy? I just mean that it was a proper learning experience, and I expect that the market will be better. It didn't end anything. No one collapsed, and I think we'll improve.
That we know of.
Yeah, we don't know.
But my point is, as an industry, I think we've been waiting for regulation. We're a very different environment and regime now. But I think as an industry, it will serve us well to put together some guidelines of how we want to operate. I'll give you an example. There's a tweet of Brian Armstrong a couple hours before all this went down where Coinbase now allows 50x leverage.
It's about time.
But what I'm trying to say, is that the right thing to do? And look, I get that we are touting ideology in this industry of decentralization and openness. But there comes a point where you ought to wonder if that is the best product for this industry. And are you playing a short-term game or are you playing a long-term game? And I think the retention of customers in this industry is non-existent because the longer you spend time in this casino, the more likely it is that you will walk away. And so I think that we got to look at ourselves in the mirror and say, I think we need to reduce the dependency on exchanges. I think we need to reduce the dependency on it being the only funnel to acquire users and to serve this technology. We're selling ourselves short. There is stablecoins, and stablecoins in their own right, as a tokenization product, we don't need to innovate more than that for this industry to be 10 times larger and transform businesses.
So what exactly are you saying about exchanges?
What I'm saying is you want to sell a stablecoin to a business, or you want to sell a product to a consumer that delivers value because people want to save dollars and earn yield. That's a great product because there is no financial infrastructure in the rest of the world. You walk into the casino, you're not going to think like that. You're going to be served a 50x perp, and you hear your stories about, you get caught up in that game. And so as an industry, it will serve us well to look at ourselves in the mirror and say, gosh, is this the best thing we can do with this goddamn technology?
So are we attracting investors? Or
No, we're attracting speculators.
We're attracting gamblers.
And so I get it. The financialization is great, and speculation is a prerequisite substrate to onboard users and get attention. But goddamn, we've been 12 years in this shit, and the tech works, and we should do a very different go-to-market.
I agree with that.
Hold on a second. Hold on a second.
But you're not really proposing, or I don't think you're.
Have you heard about inversion?
Yeah, it's a pretty damn good project I heard about. But if
Someone have to fucking do it.
No, it makes a lot of sense. Get some proper products in there rather than kind of these addictions. But you're not really proposing that we come up with some credo for the space, and that is going to direct us in a more moral direction.
I hope you're not.
Well, just in the sense, not that it's a bad idea. sort of idea in principle, but that it's perhaps sort of somewhat unworkable.
Yes, if you're a user aggregator, it is on you to protect your users.
Yeah.
Because you are optimizing for unit economics, LTV to CAC. And right now, there's terrible unit economics.
So why was Brian...
Because they're
why
thinking...
is Coinbase doing that?
Because everyone's looking at the same bullshit numbers, which is the penetration of this industry is less than 5%, and you get around this whole ideology that, like, look, you get the next sucker.
Right.
Okay, I don't usually find myself in the situation of defending centralized exchanges, but let me erect a defense. So first is that most users on exchanges do not trade anywhere near the max leverage, right? Okay. So like anybody who's offering one of these products knows, so by looking at the user flow, average leverage of people who trade with leverage is closer to like 2 to 3x. It's nowhere near that.
I see that's not true because
it is true. I will tell you as an exchange investor, that is true.
We're one of the biggest affiliates in the world for exchanges, and we know that the default setting on an exchange is 10x. And
do you know what the average trader is trading with?
Well, it depends when you say average. If you're taking the if you're using average as the long tail in terms of numbers, I can tell you in terms of volume. I can tell you the average in terms of volume is very much near the 10x button, if not even higher. And I know because I could see how the base got liquidated this weekend. And anyone who was on 1 or 2 or 3x didn't get liquidated. But those that were on anything...
A lot of people got liquidated, even
on
1,
Binance,
2, 3x.
On Binance.
On Binance, yes.
On Binance. So I think my post-mortem of this weekend is not as generous as your post-mortem of this weekend. I think that the decentralized part of the blockchain actually succeeded very well. Solana passed the ultimate stress test. I think ETH failed the stress test, putting through transactions. Like I was getting quoted $400 gas fees, but I think people were posting gas fees of $1,500. So I think Solana passed the flying colors. ETH showed, I think, its true colors in terms of it's unusable on the layer 1, specifically when it actually gets tested. The perps dexes, the decentralized perps dexes, handled beautifully. Hyperliquid handled beautifully, probably one of the best. It passed the flying colors. Then we look at the centralized part of the industry, and they fell terribly. They were manipulated. People got liquidated when they shouldn't have got liquidated. Tokens went to absolute zero. It didn't happen on the decentralized exchanges. So I think, for me, the silver lining is that where we're heading to, which is the decentralized world, actually did very, very, very well. The minute we brought back centralization, I think, I mean, I'm going to say the quiet part out loud. I think that this was a very highly coordinated attack. I don't think that this weekend was coincidental. I think that this weekend was very, very, very highly coordinated. Let me give you some. Well, I'm not going to say who I think because it's too late. No, I'm not going to say.
The debate is going in a very different direction.
But hold on. Let's just talk about some facts. When did this liquidation happen? After the US markets were closed, when Europe was asleep, and when Asia wasn't online yet. Okay, period of zero liquidity. Where were the market makers who are always there, who are paid by the protocols in tokens to provide liquidity? There was no market makers.
Yeah, they bailed.
Why did CoinGlass get attacked? I don't know if you saw, but there were that CoinGlass, who was supposed to give the data as to what was actually happening in the market, got hacked at exactly the same time. And the oracles got manipulated to give you prices close to zero. You want to tell me that that's not a coordinate? And by Monday morning, everything's fine. Like if you switched off your phone on Thursday, you arrive back on Monday, you didn't even know what happened. Now, by the way, it only happened on the centralized exchanges. On the decentralized exchanges, nothing happened.
So maybe if you work backwards from this idea that, look, crypto is a system that it will constantly be attacked because as it's a very adversarial environment. Go talk to any founder in DeFi and they'll tell you, like, you build Lindy, and there are protocols that have built a lot of Lindy. There seem to be common recurring themes as to why things fail, oracles probably being the number one, and then market structure just happens in these, like go talk to a high yield bond trader and he'll tell you the same thing, that the high yield market sometimes really dries up. So what should we be like, do we draw a line of like, I know it's permissionless and I know anyone can do whatever, but are there, as an industry, should we focus on, if we just assume that this is not going to be fixed, should we work backwards from there and say, hey, maybe we shouldn't be tokenizing, to your point, like maybe it is worth taking a little bit of a buffer and saying, let's maybe hold off on opening Pandora's box, or maybe Pandora's box been open and you can't peel it back.
I think it's the other way around. I think that it's the centralized part of the industry that is controlled by centralized figures is destroying the part that's actually is the most vulnerable, and it's destroying the part that's actually working. If you look at the collapses that have cost us money in this industry, you look at FTX. Okay, that was the centralized party failed. You look at the the Lunar, what subsequently came out as the Lunar manipulation, it wasn't the protocol that failed, it was a centralized party that failed. And so time and time and time again, I think that what we're seeing is the quicker we move to a decentralized, non-human, non-manipulatable, non-corrupt situation, the better.
Well, I would say some hyperliquid traders might have an objection to building a Frankenstein of like just an automated liquidation. Are they reading the fine print of how that mechanism is going to work? Like, I mean, Haseeb, you guys are very involved in that protocol. I don't know if you have an opinion, but like, you know.
Yeah, I mean, so in a world where hyperliquid exists, it's very difficult to argue that like, oh, well, you know, the centralized exchanges, they should protect you from taking on high leverage, because there will always be some protocol available to you somewhere where you can go get 100x levered, right? Coinbase is offering 50. 50 is like basically kind of the median, I think, for most exchanges that offer high leverage.
There's some
hyperliquid offers more than that.
There's some exchanges that offer 1,000x leverage, and to be honest,
1,000x leverage is a joke.
So to be honest, I actually took a trade. I took a trade on a.
You took a 1,000x leverage trade
just for fun, just to see how the thing works. And you cannot believe the speed at which this trade moves. It is.
How'd it go?
It is absurd. I lost my money. I lost my money. I don't think you understand. I don't think you understand how scary
that's like
1,000x leverage.
Right? No, I know. That's why I think it's mostly self-correcting.
Yeah, that's the thing. There's a reason why people don't offer 1,000x leverage, is because your customers will immediately churn because they will lose all their money. They're like, look, we're investors into Bybit. We're investors into BitGet. We know a lot of these exchanges. We've known them for a long time. It is just not true that people come on these things and gamble at 50x leverage and lose all their money. You would immediately lose all of your clients. That's not how these exchanges work. Most people trade at relatively low amounts of leverage, but the headline number gets somebody in the door because it's like, oh, this exchange only has 10x leverage or 5x leverage or whatever, and maybe the moment that I do have super high conviction on something and I want to take an insane punt, I might. The other thing to remember is that most people are not trading alts, right? Most of the open interest in crypto is on the majors. And Bitcoin and ETH did not move anywhere near the ferocity that you saw in alts, right? The alts unwind was very much for a different reason than what you were seeing happening in the majors, right? Bitcoin traced from, what was it, 120 something to like 110?
Well, let me just maybe frame the question. Matt, I'm going to throw this question to you. How much damage do you think that that last Friday did to the cycle? You had, they say 20 billion in liquidations. The on-chain data shows that it's probably way more. They say 1.7 million people got liquidated. I think it's way, way, way more. How much damage did that do to this cycle? I know in the big scheme of things, we'll probably forget that this weekend ever happened.
Yeah.
But in this cycle, how much damage was done?
I mean, so my starting point, Bitwise serves primarily professional investors, family offices, financial advisors, institutions. And my view is this cycle, which I think is going to extend for many years, is driven by those investors coming into crypto. And everything else doesn't really matter for the term of the cycle. So given that framing, the answer is not at all. Because those people closed their computers when Bitcoin was at 117 and opened their computers when it was 115. And the weekend literally never happened. Like my ETF didn't experience the weekend. And so
Bitcoin also didn't experience the weekend if you look at it.
Well, there's that. That's a whole other thing. But I don't think it's, I think this is unique to this corner of the market. And we've seen these sorts of giant liquidations in the past, and actually they're non-determinative of future returns. If you look at the last 6 largest liquidation periods, 3 of them ended up a year later, 3 of them ended up down. So that's slightly negative skewed versus the average, but they're not like deterministic. And because this cycle didn't affect who I think is, or this weekend didn't affect who's driving this cycle, which is professional capital that are at 0 going to 3%. I think that's what's driving the cycle. I don't think it will end up mattering.
So totally agree with this. The other thing to remember is that we're talking about perpetuals, right? We're talking about futures. And these futures are zero sum. It's very easy to forget that. But futures are zero sum, which means that for every dollar gained, somebody lost, right? But like it's 1-to-1. There is no creation or like it's a pot of money and people are betting on who gets the pot of money. So the liquidation was good because it has reduced the leverage in the system. And clearly there was a lot of leverage. I mean, we saw all the craziness going on with the BNB coin rotation and all the leverage trades people were making, and all that stuff has gotten unwound. That's healthy.
40% of the entire crypto leverage ex-CME, because obviously CME was closed, 40% of the entire leverage of the market was completely wiped out.
Yeah.
Between
and this
That's
happens
great.
routinely. This happens routinely in bull runs, is that there's a reset. A lot of traders who are taking leverage one way or another, they get wiped, and we start over now with less leverage, more spot driven than futures driven.
Yeah.
And that's healthy.
Yeah.
Yes, I agree with you, but the reason why I agree with you is because I think this cycle is institutionalized. And as you said, the institutions, they were playing golf on the weekend.
Totally.
I think I had to remind a lot of people today. We have a call every morning, and I had to remind them, like, guys, not everyone follows crypto every minute by every minute by every minute. Some people will check the price on Thursday and check the price again on Monday.
The people driving the market can't pronounce Solana.
Absolutely correct.
That's a meme right there. But I do think it matters on the margin. I get it. The ETF flows and have been instrumental in this cycle, and they're the front row seat, and they're driving. There is an element of RWAs which is emerging, and I do wonder around this tokenization aspect of if you're bringing more tokenization of different instruments, and you look at the market structure. Stuff like Athena and how you could have an opinion on, is it okay to hard code? I do think it poses the question of are we ready to bring this kind of more and more RWAs on chain? What does that look like? Because again, you're moving from a paradigm of Monday to Friday, 9 to 5, orderly markets. You close your computer, and
you can phone the Nasdaq,
and you can phone the Nasdaq to like now real-time markets, global liquidity, composable, interoperable in real time. Like, I don't think we're there yet.
Yeah, so building on that point, exactly. The topic of debate here was kind of meant to be something to do with public-private markets, and
but you always
not that matters, by the way. Not that it matters. And actually, I was thinking before, it's actually the wrong question in a sense. I think we all agree the destination is like tokenization of everything, and radical markets are just different descriptions. And so, and your point, I think I agree with, which is like, are we ready? We should think carefully about that. And putting aside, any conspiracy theories, I'm not saying that there isn't mileage in that, but let's put that aside for one moment. I think we can probably all agree, although I'm surprised by your opinion on this, that leaving it to the market to decide, for centralized exchanges to decide what they want to offer in their kind of shops is probably the best way to go. In fact, the only kind of workable way to go. And then things will self-correct. But what I wanted to point out is something that you said, Haseeb, and I think Santos, you commented on. You said, well, actually, you suggested we could do work on it. How do we make sure that people think about the entanglement we have between these, in this real-time world, between decentralized and centralized worlds? Think about the scenarios that we're going to encounter in the future, simulate those. And also, on your point, I was actually surprised. We can, of course, we can programmatically come up with a lot of scenarios and test rigs for those APIs, and we should. I mean, I've done it myself back in the day, and I'm sure we could come up with the most probable ones if that was the right way to do it, and some folks do it. So I think, for me, that sounds like an opportunity for building new companies and products to solve these problems, which is
it's very simple. Stablecoins, like, let's just work from fundamental premise, which is there is a lot of financial literacy, and you will never change consumer behavior. Stablecoins, programmatic yield. You look at JP Morgan, the amount of money that sits on checking accounts that is not sweeping into a money market account is staggering. People are not sophisticated with their money. Like, that will never change. As much as we want to drive technology, it will never change. So a stablecoin that comes in and programmatically rotates and does that for you within a certain parameter that is expressed with code is beautiful, because it eats into the business of banks, and it translates consumer preference to people that should be earning a very low risk treasuries, 4 or 5%. That's great for consumer. That's great for the economy. Stablecoins as programmable money is amazing. That we should lean on. And I think that's great. But assuming that people have, and then the other extreme of that is allowing your grandmother to go 50 times levered on Dogecoin. But somehow I think
there's a market for both.
But I do think that's where we need to draw the line around. We are in an excellent time in the industry to craft sensible regulation, and I think this is a moment to get rid of archaic rules and regulations and do sensible regulation, because there is more financial products that are available for people.
So what do you think we should do with the grandmother?
Yeah, so with the grandmother, it's very simple. Like, you have on one end accredited investor rules that make absolutely no sense, that were drafted, predates the internet, and they're like, if you make $200,000 a year, somehow you're equipped to make investment decisions. There's, of course, the knowledgeable investor rule, which allows people to prove that they're knowledgeable or an insider in a company. And I think we should lean more on that, right? If you're an exchange, we'll gamify it. Binance does this to some extent, or like you have to answer a questionnaire, or do you understand kind of how this works? You understand how perp
Are
works?
you sure you understand how
But-
Santos leverage works? Yes.
And I do think that we should, we're in a world where we can create UI, UX that qualifies people such that they really understand what they're doing and prove that you have the financial literacy to go 50x levered. I don't think exchanges are doing enough of that.
So I will take the other side of that, is that actually, so I mostly agree with you about people who are trading high leverage, they're just gambling. I think we were just talking about this backstage, is that like apparently in Monaco, there's famous casinos in Monaco, but if you're a Monaco citizen, you cannot go into the casino.
No.
Only foreigners are allowed to go trade or go gamble in the Monaco casinos. Same thing in Singapore actually, is that Singaporeans are not allowed to gamble in Singapore. Only tourists are allowed to gamble in Singapore. And so I'm sort of partial to like you take one or the other, right? If you are, look, if my grandmother would unfortunately not trade, or fortunately for her, not trade Dogecoin.
You never know.
But if you are sufficiently motivated, you will figure out a way to pass the test to allow you to trade Dogecoin. And when you do, I don't know that that's much evidence that you should be going 50x long Dogecoin, is that you understand how liquidations work, right?
Yeah.
But I think at the same time, it's like, look, either you say this stuff is socially harmful and we should make it impossible for people to do it, which I think DeFi makes it very difficult to actually enforce that. But put that aside, I think either you should say, look, people shouldn't be allowed to do this, period. Or you say, like, look, people, these tests are superficial.
It's very simple as opt-in, opt-out. Like, go look at Richard Thaler, like behavioral economics of like how you design a product. Like, to your point, if the default leverage on an exchange is 10x, we have a problem. Because people got liquidated over the weekend on 1.5 to 2 times leverage because the Oracle, like, this is a very volatile asset class. Let's work backwards from, shit's going to go down 80% in 20 minutes. Even if you have 2 times cross-collateralized, cross-market, you're going to get blown out. And so that's where I kind of draw a line. Like, the default shouldn't be 10x. Maybe it should be 1.5 or 2.
But I think there's twice in the last 6 months that you would have been blown out on 3x leverage. In February when Trump announced tariffs.
Let's think probabilistically.
Yeah. Sorry, Ren, what is this exchange that's 10x by default?
I don't want to mention it because you're an investor.
Oh, okay. Yeah, I don't know. All right.
I mean, most exchanges, if you go into the leverage, the default leverage is 10x.
Nice round number.
Right.
It's a great, yeah.
Yeah.
And I mean, remember, we have a big community of traders, and we can see what they're doing. And the leverage, the average leverage that they start off is 10x. No one starts off with 2x.
But I agree with Haseeb that the market will determine how that plays out. As the market broadens, as kind of the consumer base broadens, and unfortunately as people suffer from more Trump tweets, that some will happen and people will no longer choose the platform.
I mean, look, you see this with Robinhood, right? On Robinhood, you cannot, like, they don't have trade with leverage, but they allow options. And with options, you can construct any leverage profile you want by just constructing your option in such a way that it's basically equivalent to taking on 20x leverage, 30x leverage. So the reality is that people, if you don't give them leverage, they'll buy some crazy meme coin that is effectively leverage.
Yeah, I think I mostly agree with that. I think it's mostly self-correcting. Like, people don't buy meme coins. That's self-corrected. Many people are skeptical of ICOs. That's self-corrected. I think the industry would be better off if it didn't exist. So I actually agree on that point.
Industry would be better off if what didn't exist?
Well, if we didn't have 100 and 1,000x leverage. But I think there are downstream consequences of making that impossible that are probably larger. And I would add, I think we're over-focused on this element of the market. If you put this in a traditional context, and these were stocks, and X% of levered traders got blown out over the weekend, it wouldn't change people's view on NVIDIA. Right, it wouldn't change people's view on the stock market. I think that's probably true here too.
I mean, it's kind of crazy that we're evaluating the merits of this technology because the price goes up or down. Like, people don't make a decision to use AWS or Azure because the price of Microsoft or Amazon goes up or down. Like, hopefully you get to that state soon.
I think the
Solana,
whole industry is around creating value, and when you create value that didn't exist, people are going to trade it.
Yeah.
And so I think that is how you got to evaluate the industry, is how efficiently value can trade, because all we're doing is creating value.
But also because most of the value we have delivered to date has been associated with the kind of world casino, not the world computer. And to your point, hopefully we go beyond stablecoins to RWA.
So Solana gets 70% or 80% of its revenue as a chain from speculation and meme coins. we were going to get to a state where we will onboard users. We will have activity that is not correlated with the self-referential reflexivity of this industry, which is it's all tied to a casino. Again, we're selling ourselves short as an industry. We will fix this one way or another, whether it takes 20 years, 5 years.
So that's my next question: is who's going to fix this? Is it going to be Binance, Bybit, BitGet, all the ones that you mentioned you're invested in, or is it going to be the banks? Is it going to be Robinhood? Is it going to be JP Morgan? Is it going to be who's going to fix this problem?
Wait, why are you looking at me?
Because you're an investor.
All right. Look, I think the answer, I'm very partial to the answer, is that it mostly fixes itself. Is that in the early days of any technology, of any big installation of a society-shifting movement, there's a lot of speculation, always, whether it's railroads, canals, the internet, telecoms, all of them had gigantic bubbles. All of them had a lot of speculation. What drives speculation? The answer is excitement. Excitement is what drives speculation. People don't speculate over, GE and, washing machine companies because they don't care. So now that all being said, are there things you can do at the margin with respect to market structure to make markets more stable and reliable? Yes. And the way that we're figuring this stuff out is not because there's some global regulator overseeing Binance and making sure they do the right thing. It's Binance doing the right thing, or they die and they get replaced by somebody else. So I think the reality is that this industry up till now, in spite of all the regulatory fury that's been pointed at it, it's mostly been self-regulation that's gotten us here. Right? Binance doesn't work the way it does because someone told them to work that way. For Coinbase, maybe you could say, okay, well, obviously they're hewing much closer to regulations, but the vast majority of crypto today trades on Binance. It's 40% of the global market. Coinbase is less than 5% globally of what happens in crypto. And so that global market has gotten the way it is through basically learning by doing, through repeatedly going through these getting punched in the face moments like we had this weekend and figuring out, okay, what can we do better to do this better next go around? And I think that's mostly going to continue.
I'm interested to know, just from the audience here, how many of you got punched in the face this weekend?
Well, if they did, they're not going to raise their hand.
I'm really,
three.
I'm really keen to know whether
this is not the leverage trading crowd.
What I want to know is how many of these people actually did get punched in the face just because they took 2x leverage. Because I think 2x leverage is a responsible leverage to take, right?
I think that's a responsible.
That's financial advice.
You're not responsible.
Yeah. 2x on Bitcoin or ETH is not irresponsible.
Well, you got to look at it in the framing of volatility. Yeah, it's a lot, but yeah.
It's still levered. Yeah.
Look, most people don't trade with leverage. The notional of people trading with leverage makes it a very, very large number.
Yeah.
So you think it's just completely insignificant in the big?
It's not completely insignificant, but again, like there are as many people who made money as who lost. That's how perpetual swaps work.
Yeah, well, look, I'll tell you what I think, which is there's a whole segment of this industry that people are waking up to Bitcoin with products like yours, and that's phenomenal. That's great. Getting off of zero is important. Bitcoin is an instrument that is a commodity. It's like very separate out bucket and the rest of the industry. I think our focus at Inversion is really this idea of injecting this technology in businesses and making them more efficient. And I think there are very specific operational improvements that you can make to a business if you introduce stablecoins. And I mean, it's huge. Working capital, settlement times, conversion cycles, like that is a very measurable impact that, heck, it's even more than AI. Yield. Like if you look at the drag, it changes the consumer relationship. You look at large, and the best part of this is large companies, public companies are now doing this like Nubank. They've really improved their unit economics, their onboarding, their customer acquisition costs has gone down because people in Brazil and Latin America want to get access to dollars and tokenized dollars. And that is just one example of, again, moving away from pure speculation, which is always going to be a good thing. It's a good precursor. It's important. I get you. But I'm excited more about that. And as an industry, very few people, I think, are focused on doing that.
I think Mike Novogratz actually mentioned and Tom Lee mentioned the concept of energy, and energy bringing in investment. And I think that the casino did bring the energy. Like you got to give it the casino. The casino brought the energy.
The casino is a side effect of the energy. It's not the cause of the energy.
Well, I think you were saying there's no such thing as bad publicity in some senses. So it brings more people to focus their attention on crypto. So, if maybe that's too cynical, but I mean that's helpful. But I'm 100% behind the point that these are lessons for us as an industry. And if you take Binance, they're having to compensate people. That's a real cost to them, as well as the kind of maybe the few customers are put off and they join another exchange. And so they hopefully will fund internally, or maybe in a startup through Easy Labs or whatever, someone building something that might solve some of that problem for them and architect their infrastructure a little bit better next time.
What do you
What's
think?
gonna happen.
What do you think of Binance refunding or compensating? Not refunding, compensating customers. What are your thoughts there? Is it an admission of guilt? Is it an admission of guilt? Is it a?
I don't take a moral position on it. It's more kind of like if that's their decision in the context of being competitive, and so they should go ahead and do it. And it's not like it's flies in the face of kind of like the decentralization of a protocol or something. They can choose to do it.
If you're a serial gambler in Vegas, the Caesars will fly you out. And they'll invite you to the Super Bowl.
That's a great
and
analogy.
they'll give you free lobster.
It's great analogy. It's marketing expense.
I mean, if you're fucked up and they know they did,
yes,
and they said it very clearly, these assets should not have depegged. Yeah. We should not have had the inability for people to redeem, and like market makers were unable to get inventory to Binance.
That's very different from Binance flying you to the F1 to watch a race car drive.
Binance does that stuff too. Well,
no.
That's not it.
I'm not disagreeing with you. I think it's an admission of guilt, and it was a clear market failure, and they're now admitting to that, and then say, yeah, like we were owning up to that. And
but hopefully they're not just tactical about it, and they help us.
Well, look, it's also important to understand, Binance is the biggest fintech company in the world. It's the biggest fintech and most valuable fintech company in the world. They're bigger than Stripe. They're bigger than all these other companies, right? They're bigger than PayPal. And it
is bigger than Stripe and PayPal.
And the thing to realize, like we talk so much about what's going on with stablecoins. The reality is that the most distribution of stablecoins happens through Binance Pay and Trust Wallet. De facto, that is how most stablecoins are distributed today. So Binance has their tentacles in almost every country in the world. By default, they're usually the dominant player in almost every market in emerging economies. Now, I think there's a lot of stuff that people can do better than them. But right now, we have to give it to them that they are a big part of why this industry is so big globally, outside the US.
Well, Tron to some extent, too.
Yeah. Tron is the rails on which it runs, right?
Well,
but it's their software.
Yeah. All right, guys.
5 years from now, do you think that still is the case?
No, I don't think so.
Definitely not.
I agree, no.
If we're here in 5 years and that doesn't happen, we've done something terrible as an industry.
I agree with that. I agree with that.
So I think now that we all agree, I think time's up. I think now we can maybe start talking about the actual topic, which is the blurring of the lines. Guys, thank you very much. We are completely out of time. Guys, thank you.
Thank you, everybody.